The pros and cons of conventional mortgages. Buying a home is a big decision and most people need a loan to make it happen. But with some of the type of loans out there, you might be wondering which one is the best for me.
It really depends on the situation, but today I'm going to explain to you one of the most common loans called a conventional mortgage and walk you through the good and not so good parts of it. By the end of this video, you'll have a better idea of whether this loan might be right for you or not.
Let's start with the pros. You don't always need 20% down. One of the biggest myths out there is that you need to put 20% down of the home's price if you want a conventional loan. That's not true. Conventional loans let you put as little as 3% down payment. Let's say you're buying a home that costs $300,000. Instead of needing $60,000 for down payment, you might only need $9,000. That's a huge difference. Of course, you will need to talk to your mortgage advisor to see if you qualify, but it's good to know that you have that option out there. Mortgage insurance isn't forever. If you put less than 20% down, you'll have to pay something called private mortgage insurance or PMI. But here's the thing, PMI doesn't last forever. Once you paid off 20% of the house, PMI can be removed. There are even ways to lower your monthly payment by financing the PMI into your loan. You'll definitely want to talk to your financial advisor, your mortgage loan officer to figure out what's the best option for you. But it's nice to know you won't be stuck with the PMI forever. You can use the loan for different kind of homes. Conventional loans aren't just for the house you live in. You can use them for a vacation home or even an investment property. So if you're dreaming about buying a beach house or a place that you can rent out, a conventional loan might work for you. Not every loan program lets you do that. So this is a big plus if you have plans to buy more than just your primary home. Higher loan limits. Another great thing about conventional loans is that they usually let you borrow more money than other type of loans, like FHA loans. These can be really important if you're looking to buy in an expensive area where home prices are higher. In some parts of the country, like New York or California, conventional loans have a special limits. This means you can get a bigger loan without needing a different type of loan, like a jumbo loan, for example.
Now let's talk about the cons of a conventional loan. First one would be the credit score. That matters, and a lot. One of the downsides to conventional loan is that they depend heavily on your credit score. If your credit score is on the lower side, you might have to pay higher interest rates, which can make your loan more expensive in the long run. Also, your mortgage insurance might cost you more if you're not putting 20% down. It's important to understand that lenders will use your middle credit score from the three major credit agencies, which are known as Experian, TransUnion, and Equifax. That means that the score you see when you check online, maybe on Credit Karma or your banking, might not match what your lender is looking at. So make sure you have a clear picture of where your credit stands. Second, stricter rules after financial problems. If you've had financial struggles in the past, like going through a bankruptcy or foreclosure maybe, it's harder to get approved for a conventional loan, but not impossible. There are usually longer waiting periods before you can apply again. For example, you might have to wait anywhere between 4 to 7 years after a bankruptcy, depending on the type of bankruptcy you filed. This makes conventional loans a little less flexible for people who've had tough financial times. Third, debt-to-income ratio is stricter. Lenders look at how much money you owe compared to how much you make, which is called debt-to-income ratio, or DTI. Conventional loans have stricter rules on this compared to other loans, like FHA loans, for example. If your DTI is too high, meaning you have more debt that lenders are comfortable with, it can be harder to get approved. This is why it's really important to know your DTI before applying for your loan. You can calculate it by dividing all your monthly debt payments, like car loans or credit cards, by your gross monthly income. 4. You may need reserves. Sometimes lender will ask you to have some extra money saved up as reserves. This is usually enough money to cover a few months of house payments, just in case something happens. This money isn't something you'll need to spend, but the lender wants to see that you have it available. The rules on reserves can vary, and if you own multiple properties, you might need reserves for each house you own. But it's something you need to ask your mortgage advisor about because the requirements can depend on your personal situation.
In conclusion, so now you know some of the main pros and cons of conventional mortgages. They can be a great option if you have a good credit score and stable income, but they can also come with some stricter rules compared to other type of loans.
The best way to figure out what's right for you is to talk to a mortgage advisor, and hopefully with us, so we can look at your situation and guide you through the process.
Thanks for watching. If you found this video helpful, don't forget to give it a thumbs up and share with every other person that you might know that is interested in learning about mortgages.
And be sure to subscribe to our channel for more helpful home loan tips. See you next time.